Good afternoon, everyone. This is Stephanie McElhaney, and I'd first just like to thank everybody for joining us on the call today. Before we begin, I'd like to address a few housekeeping items. The first being Amanda just sent out an email to everyone about 20 to 30 minutes ago with a link that you can click on and actually follow along with the slides we'll be showing. Not necessary, but certainly helpful. And just so that you're aware, for those that might like to listen to this again, we are recording it. So once this is done, we will be uploading it to our website. So again, if you have that link, take a look at it. You can sign on. And then the other thing to note is that you have the option, if it's easier to use the phone or the computer audio, you can use either of those. At the end, we'll be doing a Q&A session. You can use the chat feature for this. So if you look at the bottom of your screen, the second button from the right says chat. You can send questions to us that way, just so that you're able to, send questions directly to us. On the drop-down, just select Aspen Wealth Strategies host. We'll get those messages from you, and then we'll be able to answer them at the end. In the interim, just to be careful, if everybody could mute their phones or their computer audio, we would be very appreciative. Finally, just wanted to go through some quick disclosures that we have to mention. You can see them on your screen, but I'm going to read them off real quick. The opinions expressed today are those of Aspen Wealth Strategies and not necessarily those of RJFS or Raymond James. All opinions as of today are subject to change without notice. The information contained in this webinar is not intended to be a complete description of the securities, markets, or developments referred herein. There is no assurance any of the trends mentioned will continue or forecasts will occur. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Investing involves risk, and you may incur profit or loss regardless of strategy selected. So with all of that being said, I'd like to turn the call over to Andy to kick things off.
Hi, everybody. Appreciate you taking time today. This is, for those of you that have been clients for quite some time, this is a new feature for us. Want to be able to communicate with all of you in one of the most effective and efficient ways that we can. So we will be doing conference calls, kind of spread out throughout, probably throughout the next couple of months. So today, our main focus is, I pulled in our investment committee meeting. Most of you know Joel and Kay do a lot of the trading and execution of the strategies in the portfolio, but it's the investment committee that brings through ideas. Kate and Joel, we vet ideas and look at implementation from there. So one of the things that we're going to start off with, a little bit of a timeline. Kate will go over as far as the trades that we made. As many of you have heard us say that we were prepared coming into this. So we'll go over some of the trades that we made, some of the trades that we're making recently, and also what some of the things that we can do moving forward. Ryan is going to talk about performance versus the benchmarks. So how basically current performance affects the overall financial plan. And then Joel is going to finish up with economic data. So that's the rough agenda for today, and I will turn it over to Kate.
Perfect. Good afternoon, everyone. Like Andy said, appreciate you guys taking time. I'm just going to kind of start off about 18 or so months ago, about the summer of 2018 and kind of how we've been positioning portfolios since then. So going back to the summer of 2018, that's when we first removed our high yield specific positions. We wanted to rotate our focus on the fixed income side of the portfolios towards quality bonds. We wanted our bonds to act like bonds. The other things that we were doing in that summer were kind of shifting our focus on the equity side of things towards large cap and specifically domestically. We were peeling back some of our international exposure, and we were also changing the way we were getting that exposure, kind of favoring a more global approach. Then, obviously, the fourth quarter of 2018, we saw a pretty significant sell-off. Basically, the days right after Christmas, we rebalanced into that sell-off because, we thought that it was a good buying opportunity. That brings us into 2019, where no giant changes were made. We were pretty much just trimming profits along the way as we saw markets rise. We did continue to favor large caps over smalls and mids, and we did start to shift our focus on the equity side of things away from growth and more towards an even approach, where we were kind of at a growth and value parity, so evening out that relationship. And that brings us into 2020, where about mid-January, we rebalanced all of the portfolios to get back to target allocations. Obviously, 2019 was a really good year. Wanted to make sure that we were in line with where we wanted things to be. And so we added a little bit to international. We raised cash for people who were in distribution mode. We wanted to make sure that coming into 2020, we had all of those distribution buckets full. And then moving into February, as we started to see COVID-19 spread and get more data on the situation, we reevaluated our positions, moved out of international, and then later in February, we sold some stocks, bought shorter duration bonds. Earlier this month, around March 6th, we added a hedge position. And then later that week, we added to the hedge position, and then we added to that again on Friday and moved out of more of our equity positions, and also added to cash. That kind of is a brief summary of the positions that how we position portfolios as of today. And with that, I'll kind of turn it over to Ryan to talk about what performances looks like.
Yeah, so year to date, obviously the markets haven't done what we wanted them to do, obviously. We came into the year thought we were a little overvalued, anticipating volatility. We didn't expect to this extent, obviously. But the trades our wealth managers have made have certainly benefited the portfolios. We are year to date down much less in every portfolio compared to our benchmarks. And the reason we want to have benchmarks are we want to be able to measure the changes, the active changes we make. So if we add a hedge position, go short term with fixed income, we want to make sure that we're doing the right thing and we can value or judge ourselves against it. And just using our probably most popular portfolio, Balance with Growth, our year-to-date return, we're down 12.68 versus our benchmark of 17, basically 16.99, so 17%. So we have an excess return of 4.5%. What that does for us in a planning standpoint, when we model the plans, we're looking at how we're using the benchmark returns. So if the portfolio managers can get us returns in excess of our benchmark, that just helps everything out a little bit better. And for a year to date, 450 basis points of excess return is pretty darn good. So when you see that the market's off 30%, just know, one, the benchmark's not even off 30%, and our portfolios are holding up quite well against the benchmarks.
And everyone, this is Steph. As Ryan mentioned, in terms of the ties to your financial plan, our financial planning software bases our projected returns off of the benchmarks that we're using for your portfolios. So when we aren't pulling back as much as the benchmark, that's good for your plan. When we're outperforming your benchmark, that's good for the plan. So basically, we want to at least track the benchmark, and that makes sure that your plan is still on track. But if we're doing better than that, which we have been, your plan is still okay too.
Yeah, having a 4.5% return out of the gate, jump on the benchmark is pretty nice for the rest of the year. There'll be times where we underperform it, hopefully briefly, but in the long run, we generally outperform it, and that's what we want to make sure we focus on.
And I just want to remind everybody that in your plan too, and I know we've talked about this in meetings over the last couple years, but we did peel back the return assumptions in everyone's plans. We call those our capital market assumptions, but just what that means is when we're projecting returns for portfolios, positive or negative, we've wanted to make those a bit more conservative because, again, we want to make sure your plans are going to hold up, even if we see more subdued, return conditions over the next 5-10 years. So again, we've built as much conservatism into your plan as possible from a return standpoint. And to, Ryan's point about the benchmarks, we're still tracking very well inside of everybody's financial plans.
Yeah, with that said, that kind of covers the performance, and I'll pass it over to Joel.
Hi, everybody. The theme that I kind of want you to walk away with today is possibly overdone, but perhaps not done yet in terms of the markets. So what I want to run through first, and then we have some slides for those of you following along online. Unfortunately, we have an epidemic of uncertainty and visibility right now. Obviously, the healthcare aspect of what's going on, it looks like it's truly going to be a human tragedy, especially in Italy, and possibly even places like India and Iran, where this really hasn't even taken full effect yet. So those are the things that obviously we're all concerned about. We all want to take care of each other as part of a global community. But what I want to focus on in terms of this call for you, our clients, is really the economic impact of that. And unfortunately, when I talk about having an epidemic of visibility, we simply don't know what this looks like yet in 6 to 9 months. No one even knows what the facts are right now in terms of the virus or the economy. There are very distinct splits in the medical community as far as how this is transmitted, how fast it's transmitted, how long it lives outside the body, how long it lives on surfaces. The best information that we're getting right now, even from the World Health Organization and from the CDC, are some really, really smart people's best estimates. So we're seeing that in the economy too. So just a kind of a recap of really what's happened in the last couple days. The Fed, our U.S. Federal Reserve, has essentially lowered interest rates to zero, and they are pumping trillions of dollars, that's trillions with a T, into Treasury and mortgage markets for liquidity. This is essentially their shock and awe campaign, to steal a term from the 2003 Iraq War. It's very similar to 2008 in terms of what they're doing. And this is very different than 2008. I want to put that caveat out there. 2008 was a very distinct banking crisis. That's not what's happening right now. It's similar in terms of what the market action is. And when you see violent sell-offs like we've had here in the last month, what happens is there's a cascade effect through financial markets. So almost every single publicly traded company and a lot of private companies too at least have some level of debt. All of that debt at some level has to be collateralized. They have collateral to back up that debt. So what companies are doing and individuals are doing are basically shoring up their balance sheets. So that's why we're seeing this quick sell-off. In terms of how this is affecting our economy, most of you know the big stories. Shutdowns started probably about a week to 10 days ago. The NBA canceled or at least suspended their season, quickly followed by the NHL. Major League Baseball is now suspending the start of their season. Today it was announced the Kentucky Derby is delaying until September. They haven't had to do that since World War II. So these are unprecedented shutdowns in terms of our economy. And the thing with the virus is we're not even at peak yet, unfortunately. The confirmed cases this week, I do not want you to be concerned about what I'm about to say, but unfortunately these are the facts. The cases that we have here in the United States are about to explode. Not because the virus is being transmitted more quickly, it's because we haven't been doing any testing. And this isn't a political statement of any kind, but the CDC and the World Health Organization and our government, and I'm not talking about any particular person or office here, they're in disagreement as far as how to do this. So from people that I trust, I found out last night that essentially 23 states threatened to sue the federal government if they didn't allow testing immediately, and the CDC finally caved and said, fine, do testing. So what that means to us is we're going to see an exponential growth in terms of the number of cases here in the United States, probably over the next 3 to 5 days. And to kind of help with some of the math, some of you will probably giggle at this example, but I want to drive home the point, the difference between exponential and linear math. So the CDC is estimating that we're doubling cases every 3 days. So if you figure, okay, so that's 10 doublings in the course of a month. So if there were only 2 people, for example, in Arvada that had this virus, and you multiply that to the 10th power, that would be about 1,024. So if you do that, just twice as many people, so if you take 4 to the 10th power, a lot of folks would probably say, okay, well, if 2 to the 10th power is 1,024, then 4 to the 10th power would be double that. Unfortunately, that's not how exponential math works. If you do the numbers, it's many, 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 many multiples of that. So that's really the math, unfortunately, of what we're looking at. So in terms of economic effects, and this is where the slides are going to start on your computer screen here. The first slide that I have is initial unemployment claims going all the way back to 2001 from 2020. And the reason I do it back to 2001 is because I think what we're going to see is something very similar to what we saw after 9/11. So unemployment claims, initial unemployment claims, they're released every Thursday. Last week they were still down, so we had about 4,000 less people claiming initial unemployment claims than the week prior. And what I want to do is kind of show what happened after 9/11. So post 9/11, if you look there on the screen there, on the 14th, which was just 3 days after 9/11, we hadn't gotten any new data yet. So you actually see here on the graph, the unemployment claims actually went down a couple days after 9/11 because we hadn't had new data. About 10 days later, 2 weeks later, it started to climb up, and it really spiked on the 28th there, as you see on the screen, roughly 25% after 9/11. So very fast, very violent move up in initial unemployment claims. And then we sort of tapered along there for a while, and then we had another spike in November of 2001 as the economic data started to roll in. And that's what I want to stress is the economic data is very delayed. So we're starting to see some numbers trickle in. For example, the New York Empire Manufacturing Index came in today, very, very low. Consumer spending came in this morning. It was off, but not as bad as people were thinking. So we're starting to see some numbers, but everyone is essentially guessing as far as what's going to happen in the economy right now. But I'm thinking it's going to follow a similar path to 9/11 because that was really truly a shock to our economic system. 2008, we kind of saw coming. The leading economic indicators, which I'll show here in a moment, started to go negative in October 2007. So we had a decent warning about 2008, a year prior. The fact that a recession was at least on the radar, or at least there were flashing warning signs of a recession, were there a year before September 2008. We got no warning on 9/11, and we got no warning for this either. So that's why I'm positing that it's possible the economy follows a similar path here in terms of how we're going to start to see data. In terms of initial unemployment in the last 12 months, as I mentioned, these numbers are always pretty volatile, up and down, but again, right here is where we are today. As you can see, that decline as of the last release. And this is the most up-to-date data we have. This is what I pulled off of Bloomberg this morning, still down. So again, kind of going back to that 9/11 example, we expect to see a pretty significant shock up here in the next couple days. So the unemployment rate, in terms of how do we see this kind of playing out in the long term? Some pretty frightening numbers. This particular graph, again, kind of goes back to 2000. You can see in that early 2000 recession, we kind of peaked out at about 6% unemployment. That's generally low for a recession. Typically, we see 7 or 8. You'll see 2008 go all the way up to almost 10% unemployment. But generally speaking, we see it top out around 6. That's sort of the working assumption we're going on now. It may spike a little bit higher than that in the short run. So unfortunately, here's a little bit more math for folks. We have approximately 15 million workers in bars and restaurants and about 18 million in leisure. So putting those two together, about 33 million. Now, some of those probably work in both. A lot of those bars and restaurant jobs are part-time, they're second jobs, et cetera. But that's 33 million workers combined with bars, restaurants, and leisure out of about 160 million that we have in the workforce. So the quick math on that is about 20.5%. So even if half of those workers lose their jobs, even temporarily, we're looking at a 10% unemployment rate. No one knows if that's going to happen yet. There's a Scandinavian airline, SAS, that came out Sunday night and said they're laying off 90% of their workforce. So, these are the numbers that we look at, and the starkness of those numbers is frankly staggering and in terms of how to wrap our head around it. So 10% unemployment, we saw that back in 2008. I don't think we're going to get there. I think we're going to have some fiscal stimulus come in, but I'll touch on that here in a moment as well. The leading economic indicators. Same thing, these tend to be pretty volatile, and they're generally a really, really good predictor of a recession. So we've seen these numbers kind of drift up and down since 2008, basically get really, really close to zero a few times, but never go negative. And most of you have heard me say once these numbers go negative, that's generally when we have a good predictor of a recession. We've never had a recession without those numbers being negative first. And this may be the first time that happens. So you can see here, basically where we are right now, we are positive on the leading economic indicators. They really sort of started to slow down there in the fourth quarter, but as of right now, we're positive. But why is this number so important? And the next slide will show why. Those two red shaded areas are the last two recessions that we had back in 2001 and then 2008. You'll see both times those leading economic indicators dipped below zero before those recessions came. And I can push this data all the way back into the 70s, and it's extremely consistent. But this is such a shock to the system that we didn't get that warning this time. And it's interesting in terms of who decides there's a recession. There's a lot of people that disagree on when and how and why these start. But the people that actually decide, it's the National Bureau of Economic Research. Their website is nber.org for those who are interested. They decide when the recession basically is. And it's interesting that the textbook definition for people that went to school for finance or economics, the textbook definition is 2 consecutive quarters of negative GDP growth. But NBER is actually the ones who decide when that happens. And I'll show you a couple quirks here in terms of that data. So this is our domestic, our GDP, basically our gross domestic product from 2005 to present. Pretty much a straight line up except for that little blip in 2008. That was the recession. But interestingly, from March of 2000 to December 2002, there was no negative GDP dip. We never actually got those 2 consecutive quarters. We may have had a quarter, and again, opinions vary on this, in June to September 2001, so that summer of 2001 prior to 9/11 was close to flat, maybe slightly negative, but that was really the only time that we had any pullback in that recession. But NBER declared it a recession anyway. In terms of the 2008 GDP dip, and this is where I'm going to tell you some scary numbers. You can see that big dip there from September 2008, that was about a 3.25% dip in our GDP. But from June 2009 to June 2010, the next 12 months, it was up 4.25%. And if you were to draw a straight line from the peak in September, we pretty much made back everything in economic terms anyway, sometime in the spring of 2010. So about a year and a half. Some of the economic numbers that we're hearing from economists that we trust, and again, this kind of comes to the visibility side of things. Some are saying -5% GDP for the second quarter. The first quarter, which we're currently in, we're probably going to see a small positive. This virus and these shutdowns started pretty late in the quarter, probably too late to push us negative in the first quarter. So our expectation is that we'll kind of skip along here in the first quarter and have a positive number. But the second quarter, it's fairly certain, not guaranteed, that we'll see a negative number. But those negative numbers that we're seeing from estimates, anywhere from 5 to 10%. And again, kind of comparing that to 2008, where we saw a 3% decline, those numbers are very concerning. This is very different. 2008 was, I know people remember the stock market, but from an economic perspective, it was kind of a more gradual slowdown. This one may be more of a shock, but the good news is we may come out of it much quicker as well. In terms of the fiscal policy and what we need there, and this is key, I've read a number of economists today that were calling for this. If you think back to 2008, and they had this TARP program, that was the Troubled Asset Relief Program. They had a program called TALF, which most people don't remember. It was the Term Asset Securities Loan Facility. The TALF part was basically reinstituted today. So when I was talking before about the Fed pumping trillions of dollars into the Treasury and mortgage markets for liquidity, that's essentially TALF. They've brought that back already. All in, those programs total about $1 trillion. From what the economists that we listen to and speak to, we need close to probably $5 trillion to really avoid the worst of this. The last numbers that we heard in terms of what's being proposed by Congress is about $850 billion. So again, $850 billion is what's being proposed, and we need upwards of $5 trillion to avoid the worst of this. So we need action, and we need it quickly. Now, here's the good news. As Cade mentioned before, we were prepared for a good chunk of this coming into this. The performance numbers, nobody likes being down, but again, when we compare it to your benchmarks and your financial plan, if we can save 4 or 5%, that just makes your financial plan look even better. Steph, Ryan, they've done a great job trying to educate in these meetings that we have with folks about Monte Carlo scenarios and how these types of events are already accounted for in there. So if we can actually save to the downside here, which we have been doing, that's good. But even more importantly, we still have more levers that we can pull in the portfolio. We started to add a hedge in the portfolios pretty much across the board, starting around Friday, March 6th. That was really when we first started to deploy the hedges in the portfolios. And again, the hedge, we're not really allowed to mention specific securities on these calls, so that's why I'm just calling it the hedge. Most of you know what that is at this point if you've looked at your portfolios in the last week or two. It's essentially a bet against the market. There's really no other way to describe that. I think that's the simplest and most accurate way to describe that. But since we added that hedge on Friday, March 6th, that hedge is up roughly 15.5%, and the S&P 500 is down 19.7% during that time. So again, the hedge is up 15.5, and the S&P is down 19.7. just since we added it on March 6th. And we've made subsequent additions to that hedge. In terms of where all this is going, I started this off by saying possibly overdone, but perhaps not done yet. Unfortunately, I think that's kind of where we are. There are pockets, some of them are incredibly small, pockets of valuations that we're seeing right now that are starting to look attractive, but we're not there on some of the biggest names that everyone knows. And again, I apologize, but I can't mention specific sectors or names. but it's not there yet. A lot of stocks simply are just not cheap enough to go bargain shopping yet. As I'm speaking right now at 12:33, the market is up about 1,000 points today. This is also very common, unfortunately. We saw this happen quite a bit in 2008, where markets spiked after the Fed made certain announcements. Again, today they reinstated TALF and pumped about $1 trillion of liquidity into the markets, and the market reacts positively to those things. Unfortunately, in 2008, it was never quite enough, so I don't think that today is quite the turnaround. Depending on the economic data that comes out over the next 6 to 8 weeks, once we kind of get a good feeling on what is actually happening in the economy, we'll have some more visibility. Until then, we do have significant cash positions in most of the portfolios, along with the hedge. The reason we added to cash was we saw some unsettling things happen in the bond market last week, again, centered around liquidity, from people selling and just not enough buyers. There was one day last week where the Barclays Aggregate Bond Index was down significantly, but the ETFs designed to mimic that were down even more. And typically what a lot of mutual fund managers do and professional investors do, they keep those ETFs on hand for liquidity. So there was just a stampede of selling last week, specifically on Thursday in the bond market, where it seemed for a while there was just no bottom. That particular index was down roughly 3%. Again, the ETFs were down a little bit more. But typically, a down 3% is a bad year in bonds, not a bad day. That has not happened since 2008 either. The very next day, we raised cash in all of your accounts. So if you look at your accounts today, you'll see a significant cash position there. For the most part, not everyone, but the majority has a significant cash position there. That's not going to stay there forever. Obviously, cash doesn't earn very much, but I'd much rather earn 0 than lose you 1 or 2%. So that's kind of where we are right now, unfortunately. Again, we don't have a ton of visibility in terms of how this is going to play out. We do expect virus cases to continue to spike here in the U.S. over the next 3 to 5 days. The biggest concerns with that isn't necessarily the virus itself. Obviously, for people that are elderly or have some sort of comorbidity, either heart or lung disease or some other health ailment, it's even more dangerous for them. But the death rates from this virus seem to be somewhat stable. They're certainly higher in some places in Italy, but they're lower in places like Norway. So where we end up on that curve is still an unknown. As this continues to spread throughout the United States, we anticipate more uncertainty in markets, which is going to be more volatility. And volatility doesn't always mean down. As today would prove out, there's ups and downs with volatility. You can have volatility up too. So that's why we're keeping people invested. To be clear, we're definitely underweight equity. So the metamorphosis of portfolios that Cade sort of described starting in 2008 by selling the junk bond positions. Junk bonds in the last 6 weeks are down 10 to 15%. That's why we sold them 2 years ago or 18 months ago, because they don't behave like bonds in markets like this. So we started insulating the portfolios a good 18 months ago. We came into this prepared. Ryan mentioned some really good data in terms of where most of our clients lie in terms of performance. So to that end, no one likes to see their portfolios down, but again, when it's compared to your benchmark, which is really the critical part of it going into this in terms of your financial plan. I'm not a hedge fund manager. We're not trying to, be up 20% when the market's down 10. That would take on excess risk in your plan because there's plenty of hedge funds over the last 10 years whose accumulated return is 0. Whereas the market's been up 350% during that time. So that's not what we're trying to do. What we try to do is protect to the downside with the tools we have available to us. And the message I really want to impart to you today is that we've done a good job protecting to the downside. We have more levers to pull if this gets worse. and we are ready to deploy those measures at any time. So with that, I'll turn it back over to Stephanie for a few more comments, and then we'll open it up to Q&A.
Yeah, hey everyone, this is Stephanie again, and I'm going to pass it to Ryan as well in a second, but wanted to wrap things up on a planning note. And while I'm doing this, I'll just remind everyone that, again, if you have questions that you'd like to ask us, there is a bar at the bottom of your screen. The second button from the right should say chat, and you can select the drop-down Aspen Wealth Strategies host and send us a message if you would like us to answer any questions after Ryan and I talk about the planning piece. So with that, I will just remind everyone, again, as Ryan and I had discussed before, and Joel just mentioned, the benchmark we use in your plans, we've been beating that recently, and importantly, we've been beating it on the downside. So we've been pulling back less than the benchmark, which is critical for your plan. And I'd just like to remind everyone, too, that when we go through those Monte Carlo scenarios in your plan, when we show you that probability of success wheel or that circle with the percentage in it, that has already baked in situations like this. So when it's running those 1,000 different simulations of market conditions, these types of events were already built in, and that's why we go through that exercise. That's why we're always looking at your plan to make sure that it can sustain these types of events. So, you know, when we've talked to you about that probability, we're still on track for that. Your plan is still on track, and it's because we've already kind of taken the steps preemptively to make sure that this is being factored in. So with that, I'll pass it over to Ryan real quick for some other planning items. And then again, if you have any questions, feel free to send them in, and I will ask our panel here those questions that you have for us.
Yeah.
Ryan?
So I just want to kind of end on some notes on from a planning standpoint, what some things we could be doing. We know this is scary times. Usually, as Joel mentioned, we have some warning signs to kind of anticipate a recession, but those were not baked into the economic data, and the coronavirus and then the oil war came out of nowhere. But as we all know, things can be scary, but over time it will pass and we'll be okay. Some of the things we could be doing, though, if you're in the accumulation stage, start rebalancing your 401ks. Look at your asset allocation. Your equity positions probably have dropped. You could use the bonds to rebalance and purchase more equities. As Joel mentioned, we don't think this is over yet, but we do have a 30% discount on the S&P 500. Another thing we can do is keep saving. In these periods of weakness, if you're not maxing your 401ks, try to max them out if you can. And if you notice you cancel a vacation and you're no longer going to use those funds, you can potentially put it towards savings. Start looking at the 401k first to get the max there, Roth, HSAs, which are health savings accounts, and then non-qualified accounts. We could certainly help you out if you do have excess cash, but it's not a time to truly panic. We're making great changes here that help protect to the downside, and some of the things you could do outside is just save more and look to rebalance. One thing that we always mention, part of our annual review process when we have you in, is what are your upcoming cash needs? The reason we ask this is to make sure we have cash out of the market if we know for sure you need to spend it. And one great thing we did is we, in the beginning of the year, rebalanced and refilled our cash position. So just always let us know if cash needs come up. That way we could have a game plan for it so we don't have to sell in troubled times. And then I'm going to pass it back to Steph, and she'll start taking some questions.
Well, everyone, hopefully this means we did a pretty good job because I haven't seen any questions come through. Of course, if you do have any follow-up questions for us, everyone knows you can always send us an email, give us a call. Again, our main number is 303-421-1113. Please don't hesitate to ever get in contact with us if you have any questions. And I just want to wrap things up by passing it along to Andy for some final comments.
Again, thank you all for taking the time today. I think you heard and continue to hear, we have a plan, and we're executing on that on a daily basis. Very proud of our team. You know, they certainly stand committed to your success, and we'll continue to make adjustments to the portfolio based on the data. So, you know, you can expect that. We are going to follow the CDC's practice for social distancing, plus that will ensure that our team stays healthy to continue to review and look at your financial plans, any operations and administration you might need, and of course, Joel and Kay to be able to trade the portfolios. So we will be working remotely here in the interim. So if you do email us, if you do call, we will get back to you as soon as possible. We have the technology capability to be able to work remotely from anywhere. So again, just another thing that we're prepared for. So thank you all for your time today. You know, please be safe out there. Just know that we're thinking about all of you on a regular basis, and we'll be in touch with you soon.